Mic test 1, 2, 3. Hi, good evening all. So before we start, I'm now doing a mic check. So can you all hear me and as well see my screen? Okay, good. So excellent. So yeah, let's wait for about a minute before we start. So as long as the voice is clear, the screen is good, we can start very shortly. All right. Okay, so let's get started. So well, very good evening, ladies and gentlemen. So Kelvin here, the market analyst for CMC Singapore. So thank you for your time, your evening for joining this session. So before we start, maybe let's give a bit of heads up. Anybody here totally never trade before? Trade as in we talk about short-term trading, not investing, because it's a different story. So may just give a bit of a heads up so that we could actually understand how do I approach this webinar to make it as useful as to you all. So anyone here has been totally new to trading? Okay, good, not traded before, all right. Okay, how about the rest? So okay, so I believe that most of you are a bit shy. So I do believe that a couple of you have not traded before. So, but you all understand what is the stock market in terms of investment. Okay, so before we start about what is this trading psychology about is over here is that let me flash the disclaimer slides first. Okay. Okay, so meanwhile, let me yes, so for those who wants to ask any question, you can actually type it on the chat box over here. All right, so I will actually answer your question towards the last 10 minutes of the webinar. All right, so that we could actually proceed more smoothly. Yeah. Okay, so before we start, maybe just give a brief introduction about myself and who am I. So basically, my name is Kelvin Wong. So I'm actually part of this market research team in APEC of CMC as a market analyst in CMC. So I'm close to 15 years in the market from a trading perspective and as well as doing market research as in consultancy works or for the buy side industry. That means we're talking about hedge funds. All right. So I do experience myself in taking what I call real risk before in trading. That means we're talking about we are actually using the markets to actually kind of give our bread and butter. So I do understand that when it comes to trading, it's like playing a sports game. And most importantly, in terms of trading and investing is a bit different. Why? Because investing, we tend to hold longer term. Okay, that means we talk about 3 to 5 years down the road. But however, if you are talking about trading, our realized horizon of returns gets shorter. So it could be as short as intraday. Okay, intraday means 1 day, or it could be medium term. When it comes to trading trading in medium term, we're talking about multi-weeks. Then for longer term in trading, we're talking about multi-month. Okay, rather than we talk about a multi-year approach over here. So the thing about trading and investing is that the time horizon that we wish to achieve our returns get shorter in nature. So a lot of people associate trading with gambling, which is true because why? Because we are actually betting on the outcome of the market. Agree? But however, when it comes to trading over here, if you bet with a proper mindset and a proper risk management techniques on how to actually control our emotions in trading and as well as control our risk in trading, we could skew the game in our favor. Okay, in terms of minimizing risk and how to control our psychology when we place a trade. And why I say psychology is very important when it comes to trading because of the short-term horizon. and time is not on our side. All right, time is not on our side in terms of short-term horizon, because we hope to achieve a return within a shorter span of time, 1 week, 1 month, versus investing where we have a longer time period. All right, and also let me be mindful over here is that trading is not for everyone. Okay, it's really not for everyone. It depends on your characteristic. Can you control the emotion when you're trading, and can you be disciplined enough to actually apply the robust risk management tactics? All right, so before we start, in terms of trading, a lot of us, when it comes to trading, right, we tend to look at the methods of trading. Okay, methods of trading over here is we are talking about tools of trading. It can be technical analysis, it can be quantitative analysis, or it can be based on a method of both technical, quantitative, and a bit of fundamental. How do you react to the news flow? So a lot of people emphasize of placing methods at the top of the top portion. But however, if we talk about the trading hierarchy, what matters most in successful trading is an inverted pyramid, where the top actually forms the first base before we even got started in trading. And you narrow, it's like a funnel, you narrow it down. The not so important portion, I would say not so important, it's still important, but relatively less important is the methods. Okay, so the first thing we got to tackle is this portion first. Patient and controlling emotions. Okay, so what is this patient and controlling emotions about? So all this builds on the building blocks of having a thought process in terms of our psychologically building block when we actually place a trade. Okay, so patience, it takes a lot of patience to actually wait for the trades to set up, because for most of the time, right, given that I understand that right now we tend to join a lot of social groups, be it Telegram or be it Facebook group. You can just, I mean, Google around. There's a lot of these groups. Some are free to join, some you need to pay a fee. We call it a trading community, where people will just share trading ideas based on their own style of trading, and some of them are just hoping to gain more followers. So the key thing is over here is that we get bombarded with all this kind of news from such trading group. So at the end of the day, right, we will tend to actually, instead of using a proper trading setup, we actually follow this particular noises, I would say noises in such social community, to base our trades. So it will lead to the kind of impulsive buying or impulsive selling when we take our trading setup. All right. And because of this, sometimes for no reason, our losses just get our losses get exploded, and we go into revenge trading, hoping to make back our loss as soon as possible. All right. So, but yeah, if it goes out well, fantastic. I mean, what I mean is, let's say, for example, if you lose $100 right now based on a trade, or let's say if you place a trade on the euro dollar for a bullish bet on the euro dollar for it to go up, but instead of going up, it went down. So you lose $100. So the next thing to make back your $100, you got to place another trade, which is perhaps more than $100, 150. All right. But if this trade start to lose again, you lose $250. So do you realize that if you go into this step of revenge trading, your losses could snowball higher and higher? So once it comes into this particular situation, this is where you feel very emotional. Hey, how come my losses get snowballed to a certain level that is so huge in the first place? I only started a loss of 100, now I snowball to 1,000, which is 10 times more. So once you realize this, right, then it comes to mind psychologically that, hey, I know that I'm not applying to my proper trading setup that I already have in mind, but I tend to follow the social media, the trading community that I joined earlier on, because I want to follow their style of doing things, because just to be with them. So it comes to a point that over here is that, hey, once you reach to a stage of emotional burden, it tends to create a kind of negative feedback loop inside your mind. So you will need to state of self-sabotage. That means you you will tend to find it very hard to attempt to do a trading setup, even though your initial trading setup give you a bullish signal, but you will not dare to trade. Why? Because of your initial losses. Okay, so now comes to the point that how do you accept losses in the first place? By also accepting losses that doesn't allow it to snowball to a huge level that prevent you from executing your trading setup that you already have in your initial plan. So this is more about the trading psychological part. So once you have your basis of your trading psychology part, you work downwards to kind of have a robust risk management system where you do proper position sizing, trade management, selecting what kind of markets to trade, reward risk ratio, and most importantly, the amount of leverage you use. Because for trading, we tend to margin. When you margin, obviously, let's say, for example, if you are talking about, if you are trading a particular euro dollar pair, okay, let's say not euro dollar, so let's say you are trading Tesla. So if you're looking for a bullish position of Tesla, you need not put in we call it $700 worth of Tesla share per share. You can put it only, let's say 20%, or pardon me, maybe 10% of Tesla share, because that means it allows you to leverage up when it comes to short-term trading, depending on what kind of instrument that you use, such as CFD. So once leverage are involved, yes, it could magnify your return, but it also could magnify your losses if your trade goes against you. So this is a portion of what I call risk management tool is very important, but to control the amount of leverage, and depending on what situation. And most importantly, you need to understand what is called correlation analysis. Okay, let me touch very briefly about correlation analysis. Let's say you enter two particular trade, a trade on oil. All right, so let's say if you long oil, okay, certain asset classes that is not oil related directly in commodities, they tend to have a direct movement with oil. That means if you long oil, and if you want to what I call short long dollar, long Canada dollar, okay, so you realize that Canada dollar and oil move hand in hand in the last maybe last 4 weeks. So if you long these two instruments over here, yes, you go big. That means if they go according to your position, you make money, tremendous amount of money, tremendous amount of potential profit, I would say. But however, if both of them goes wrong, that means instead of going up, both of them come down. That's the problem, because both of them, they move correlated together. Your losses will be magnified. That means you're not doing a hedging trade. That means you are doing a trade that you are exposing yourself to higher risk. Okay, so this is a portion about risk management. Then after you settle your risk management, you talk about your methods, technical analysis. So basically, how to use technical analysis to actually look at potential trading setup. So how do you identify the price action, whether it's bullish or bearish? Then from there, how do you determine the key levels? What is the support level where the price is likely to bounce? What is the potential target where the resistance is there for you to your exit, for you to take, take profit or whatever? And also selection of markets. Let's say not all markets give you a good trading setup. Don't forget, we are not here to invest in a particular stock. We're here to trade that stock. So trading that stock, we need to understand what is the current sentiment like. Yes, certain stock I do understand that you have good valuation. Okay, the valuation is very great, cheap. But if the stock doesn't move and stuck there for a period of time because there's lack of bullish sentiment, well, at the end of the day, you lose an opportunity cost when it comes to trading, because you could use your capital to trade for stocks that could potentially move either higher or lower. This is not talking about there must be an appropriate amount of sentiment that is building up in that particular financial asset they're trading, be it stock, be it FX, or be it commodity, or be it stock indices, that allows what I call rapid movement. Okay, I'll say rapid movement in the price action. So that's where you could actually realize your potential profit in a shorter time frame, because trading talk about shorter time frame. And because of this shorter time frame thing, we also got to control our risk. if the price doesn't go according to our initial, we call it assessment of the market. Okay, so in this webinar, I will talk about this portion here. Okay, patient and controlling emotion, the psychological part. I'll talk a bit of risk management. Definitely, I can't talk about methods. Methods, I will do it in a different webinar already. All right, because we don't have the time given that 1 hour constraint. Okay, so let me zoom in on the psychology part of trading, which is the most important before a trader starts to embark in this journey about trading the markets. Okay, so the first thing about it over here is losing trades, because for trading itself over here is we got to understand before what is a winning, we talk about winning trades. We cannot deny the fact that over here is that not all trading setup come with 100% certainty that we will make or we will win all the time. We got to accept the fact that over here is that, hey, there will be losing trades. All right, there definitely will be losing trades, because sometimes emotions are involved itself due to the short-term nature of trading. So what are the main reasons of, so before we cope about losing trades, first we got to understand what are the reasons behind losing trades. So the first part is trading too much. You overtrade. That means you place too much leverage, okay, that you could cope off. Okay, that means you're actually borrowing, in a way, indirectly, you are borrowing too much money to trade. You're over leverage. All right. So because of over leveraging, the negative figure, look, you are eager to make back your losses as fast as possible. So yes, if the position goes within your expectation, congratulations. But if you double down and your position doesn't goes, or the position doesn't goes according to our expectation, then well, our losses magnified. Okay, so it will become like a death spiral. Okay, then same thing, this a bit related, is poor risk management. That means you do not have a stop loss strategy. So at the end of the day, you allow your losses to keep snowballing until that, initially you only lost 5%. From 5%, you hope that you could make back another 5% to break even. But instead of 5%, the instrument dropped down to 10%. All right. Think about it as Tesla during March to June period this year, where it actually plummeted close to 15% or close to 20%. Okay, before recovering in the last 4 to 6 weeks ago. Okay, so during this period of time, imagine that over here is that if you do not place a stop loss on Tesla, your losses could easily go down by 15%. And if you leverage up, that means your 15% losses could be really more, 3 times more or 4 times more, 50% loss. So that is tremendous damage to your account. And the next thing over here is that most of us think that our method are able to pick tops and bottom. Okay, that means we anticipate whether the price will go up or go down before we place a trade. All right. So the key thing over here is that when it comes to trading over here, we do not tend to anticipate so often, because we got to follow where the price action is. If the price is bullish, there must be a clear trend, a clear bullish trend that is formed. Okay, so how do you know this bullish trend can go further? Is there is certain other technical tools to gauge the momentum of this trend. All right. So very similar, what I mean by Alibaba, you know that Alibaba tumbled by close to, I think, more than I think 30 or 41% from its February peak this year. So if we keep trying to pick a bottom in May, we try to pick a bottom in June, but the stock price keep go down lower and lower. All right, why? Because the trend hasn't reversed. Okay, so that's the key thing over here is that in terms of trading, it doesn't mean that low prices, very low prices will rebound when it comes to trading. Yes, I know that Alibaba might have reached a certain valuation that is cheap in the last 3 months or so. But once it comes to trading, trading doesn't bother about valuation. Trading at the end of the day is bother about price action. What is the probability of the price will reverse, and what is the probability of the price will keep coming down? That's my main concern about trading. Okay, so in trading over here is that I need to take the valuation equation out of my mindset. So I like to reinforce is trading is actually a very short-term time period. All right, and it may not be what I call appropriate for everyone because of this short-term nature in trading. Okay, now impulsiveness. So impulsiveness definitely is without any trading plan, you trade based on gut feel. That means you just based on your feeling that, hey, let's say for example, tonight I believe that Tesla will go up because of the earnings announcement that is going to announce later at the close of the market, without looking at the what I call it, the sentiment of Tesla right now, and we are looking at the current trend movement of Tesla and whether there's a potential exhaustion sign in Tesla in the short term. All right, so this is what I call a gut feel. And the next key thing is over here is this related to over leveraging as well. It's unrealistic expectation. Let's say for example, you hope because based on you see certain social media banner, someone turn 1,000 to 100,000 within 3 months. Wow, so you hope to achieve that. So mind you, if you do the sums of return, is 9,900%. All right, so if you leverage, over leverage, yeah, possible you reach this amount, but what if your position goes against you? All right, so the key thing over here is try to be realistic where you set your trading, what you call it, objective, like how much you want to actually potentially make within a week or within a month. Okay, so if you start this kind of unrealistic we call it expectation, eventually it will snowball back to a negative feedback loop where you tend to lose out your trade due to over leveraging if the position goes against you. Okay, so now you understand the reasons behind this losing trade. So the key thing about trading over here is, yes, we will face with small losses of trade if we have a proper trading strategy. That means we cope with what I call stop losses. Okay, stop. But the key thing is sometimes some people need to be perfectionists. Okay, like Singaporeans, we call it a bit kiasu and kiasi. Perfectionist. That means all my trade need to be 100% winning trades, no losses. Okay, no losses. But unfortunately, that's not true in life, in trading. Think about it. If you are a soccer team inside the EPL, even the most successful EPL clubs, be it Liverpool or Man U, they do have they do have losing streaks in terms of their games, potentially losing streaks. They can't be winning all the time, or even a draw for them. All right. So same things about trading. So in trading over here, yes, we hope to be 100% winning trades, but there will be losses. You got to accept that in trading. There will be losses because there is no 100% strategy that could make you 100% winning trades all the time. Okay, the only person can tell you I can make 100% all the time is you are doing insider trading, which is illegal. Okay, so now the key thing to actually to have this kind of affirmation towards losing trades over here is the reason why we are doing this is because once we affirm that, hey, we are accepting losing trade, but to a minimum amount based on proper stop losses, we could actually overcome this grief inside our mindset to spot for the next trading setup. That means to move ahead. Yes, this trade is losing, but now we got to move ahead with the next trade. Because don't forget, trading is very short term in nature. Okay, so just say out loud inside your mindset that losing trades are part of the pathway to my trading journey. I use losing trades as an opportunity to grow and learn to be a better trader. I welcome the success that comes with losing trades. I remain calm and confident that I am a successful trader whenever I make a profit or a loss. Okay, so once you affirm that trading, losing trade is part and parcel of the journey, the next key step is how do you reframe when you experience a losing trade? That means now you accept that trading is part and parcel of your trading journey. Losing trades are losing trades, but keep it to a minimum level. The next key step is how do you reframe your mind? So how do you get out of that mental block that, hey, once you face a losing trade, you get out fast, and the next step you got to move on. Now you need to keep moving forward to search for the next trading setup. Not to be fearful of this losing trade for you to place the next trade. Okay, so step one is to switch this reframing mindset is from negative to positive. Yes, I lose this trade, but looking at the scenarios that would have been worse, that means I know that at least I lose only X amount. Okay, imagine you have a trading capital of 10K. Instead of losing $1,000 of 10K, now you only lose $200, which is better, right? Because you apply a proper stop loss strategy. You make your losses, you cut your losses small. Okay, so don't drag, don't keep on fighting. Hey, I lose $200. Think about it, if you could lose more of $1,000. Okay, step two. So once you lose this trade, spend time writing down using either a keyboard or something, or your notepad, or even key on your handphone. What can you learn from that losing trade, and how will you do differently in the future? So that particular losing trade, why do you lose it? Is it because you didn't apply your trading strategy well, or is it because you trade on impulse? Or perhaps the price movement, suddenly it just moved by a fair bit, then you close your trade because you're afraid that the money will, your trade will go, much bigger, but it hasn't hit your stop loss, and the price reverse up from there if you have a bullish setup. So write it down somewhere in your handphone, or it could be traditionally a pen and paper if you want to. So after you've done step two, so you put into action. If you know that you're only prepared to lose X amount of capital, then what can you do about it? Okay, so once you reframe how you experience a losing trade, the next key step is you reframe your mindset to focus more on risk management instead of potential profits. Okay, that means instead of thinking that how much I could make in this particular trade, in the next trade, think about it, how much could you prevent further losses in your next trade? Okay, so the key thing is you need to set up realistic goals, because we cannot know in advance whether the trade that I place, let's say for example, I give an example tonight, Tesla is, or after the market close, Tesla will be releasing their Q3 results. So let's say if I place the trade before the earnings, be it a bullish one, I cannot be sure Tesla will actually go up tomorrow. Okay, I cannot, there's no 100% certainty. So the key thing over here is a binary thing. Either I lose or I make, but I cannot know what is it. Okay, it's a 50-50 bet right now, or it can be 60-40 depending on the trading strategy that you use. But we know that there's no 100% certainty. Okay, so now the key thing over here is that since we know there's no 100% certainty, so how do I minimize my losses? So the key thing over here is to place this Tesla trade, I got to ask myself, what is my acceptable risk zone? Okay, this up to individual risk zone based on your trading capital. I cannot define for you what is your acceptable risk zone. You got to define by yourself. Different people has a different acceptable risk zone. Let's say for Tesla, I'm only allowed to lose $1,000 out of this trade based on leverage. So I should know how much I should place in Tesla on the long side tonight, because I already defined my acceptable risk zone, which is a maximum of $1,000 loss. Okay, then the next key thing, if Tesla rallied up, I'm happy. Okay, but given trading, I'm not investing in Tesla. I'm not trading in Tesla. So at the end of the day, my aim is to get a decent profit within a short-term period of time. Let's say being within 3 weeks. So what's my acceptable profit range of Tesla? $300 from the entry price that I entered. So if you are happy with this profit, yes, set that as your profit range over here. Because don't forget, in trading, the key thing about trading over here is short-term in nature. Whatever positive amount you see in the trading platform that is running, those are unrealized profit. Okay, and unrealized profit can turn into unrealized losses. So in trading, we got to know how to convert this unrealized profit to realized profit by taking profits. So we got to set an acceptable profit range. Okay, so by doing that, right? So by doing that, you could actually realize the profit and not seeing the disaster state where your unrealized profit becomes into a unrealized loss where you got to cut immediately because it already hit your acceptable risk zone. That means it fall beyond your risk zone. That means you got to get out fast. All right. So then the next key thing over here is enjoy every successful trade outcome. Okay, be it how much you made, it doesn't matter the amount. It could be $50, it could be $100. So every winning trade outcome, you got to celebrate as happy, as meaningful as possible. This is what I call a reframing of a positive mindset. They said, hey, I only make $100 on Tesla trade. Wow, I'm a bad trader. No, in fact, you are a positive trader. Okay, so the key thing over here is, yes, I make a small amount, $100, but so what if the other person make $10,000? But I got to celebrate this $100 as a winning trade for me, because it's much better than losing money. You know what I mean? So this is the kind of mental framework, right? An exercise that a successful trader ought to actually keep on playing in his mindset to become profitable and successful in trading. So it's more like a mental exercise. All right. So now the next key thing over here is, once you have this reframing to focus more on the risk management and less on potential profit, the next key step is emotional orientation and financial boundaries. All right. So this one will links to a bit of risk management techniques. Like I said earlier, traders love to compete and wants to be always right in their trade. Okay, so it will lead to emotional disorientation. Okay, because you want to be always right, that means if you lose, you refuse to cut loss. So once you refuse to cut loss, your loss goes larger and larger. You get emotional disoriented, where it could destroy your initial trading plan. That means the next step is you'll be feeling very fearful to actually place the next trade, or you could even self-sabotage yourself. That means you start to trade based on impulsive behavior. So the next case, yes, winning is important in trading, but we need to know how to manage risk as well. Okay, trading is equal to risk taking. Okay, so when it comes to a trader, right, you're doing risk taking. That means we're talking about risk taking over here is you always got to manage your risk first before we talk about profits. Profits will come later. Yeah, profit is important in trading, but the key thing is how to preserve your capital for the next trade. Okay, if you don't know how to preserve your capital, it will lead to emotional disorientation. That means preserving of capital, you got to set certain financial boundaries to say that, hey, once I hit certain losses, I got to get out and reevaluate. All right. So this one will link up to a risk capital, that this is the maximum amount of capital that I could lose before I stop trading. Because we don't come to the point that you keep trading, it will impact your desired lifestyle and even your work. You can't concentrate in your work because you keep distracted by your position that is still running in the background, which is now is a losing trade. Okay, and know your limit and when to walk away. All right. So now, okay, I see some questions in the chat box, so I'll answer them towards the end of the session so that you will not interrupt the flow. Okay, so now the key thing about this is why risk management is linked to this portion here. Set out risk capital, you are prepared to lose. Okay, because of this table, Okay, so you just think about it, trading. Okay, so this doesn't involve leverage, but just pure, cash. You start out with a 2% capital loss. Okay, let's say you lose 2% of your capital. The next step to cover back your losses is 2%. All right. Okay, but if your percentage of capital loss grows larger, okay, you realize that the percentage to recover back your losses doesn't go in line with the percentage of capital loss that you have. That means it goes more exponentially. So for 10%, you need to cover back 11.1%. That means you need to make 11.1% of your next trade profit to cover back your 10% loss. Okay, imagine you start to lose 20% of your capital. That means you need your next trade to make a 25% return to cover 20% loss. This is break even. That means this is the amount of money, the amount of return you need to break even. Okay, simple as that. If you lose 50% of your capital, this thing jumps. That means your next trade, you need 100% return to break even. You lose 70%, your next trade will be more than 100%. That means 223.233 something. So if your losses grow bigger and bigger, and definitely it will go beyond your capital if you leverage up. That means the return gets exponentially more in order to break even. All right. So this is what we call it gambler's rune. That means if you keep doubling down on your capital loss, that means some people will tend to do this. Why? Because they hope that their next trade will able to cover back fast. That means you keep doubling down, hoping that, hey, your next very one trade could actually cover back all your initial losses. But what if it doesn't cover back your losses? You got to keep increasing your capital at risk. That means you need to keep putting in more capital, hoping that one day one of the return can cover back fast. The only way you can do this is you are the Fed. That means the US central bank, who has kind of theoretically unlimited amount of capital by keep on printing US dollar. So being a normal trader, we are faced with capital constraint. So the key thing about this is that this a bit of risk management is that we need to use this called mathematical system. So instead of using a medical system, we got to use anti-medical case. I forgot the I here is an anti-medical system is preferred. So if there is a trade loss, you got to halve your bet when there's a trade loss. That means you reduce your next trade by half, and only doubling it when there is a gain. That means if you start winning, then you could double up your next trade. All right. Okay, now, so we understand a bit of risk management to link to that emotional boundary is that the next key thing about trading is we got to set ourselves goals. Okay, in trading, I mean goals are what do you call it? It's a process thing. You see, that means what kind of goal you want to achieve? You want to achieve X amount of percentage within a week or within 1 month. Okay, so these are goals. That means let's say for example, with a trading capital of 10,000, I want to achieve a return of 10% every month on average. Okay, so that is your goal, right? Then the next key thing is how do you achieve this 10% a month on average? Okay, so I got to, there must be a method, right, for me to set this goal. So I come up with this, it's a concept which I found it very useful. It's a trade model, TRATE, is related to trading as well. So I name it as TRADE model. So it helps to identify your goals and plan their implementation. Okay, so it's a kind of set, measure, reflect, repeat. So it's like a loop. All right, you set your goal, you measure it, you reflect it. Okay, so once you reflect it over here is that what goes wrong, what doesn't goes right, what needs to be changed, and you repeat the whole process again. Set, measure, reflect, repeat. Okay, so what is this trade model? So I found it's a useful concept I can share with you all that I use it myself is target. So target is, let's say, what do you want to achieve? Be specific, when, where, and with whom. All right, so let's say, for example, I want to achieve a 10% return in my trading in my trading journey, 10% return for this year every month, 10%. I hope to achieve 10%. Okay. Then the key thing is, how will you know that you have achieved it? Okay, then the next key thing is what instrument you want to trade to achieve this. Okay, then the next step is how we know is that you're going to record it somewhere, right? Whether you achieve it, this is pure recording, and you need to have a trading plan with that. There must be a plan associated with this target. Reasons. Okay, why is achieving this goal important to you? There could be a lot of reasons behind it. So let's say, why do I want to achieve 10% on average per month this time around? Why? Because I want to become a better trader, because the previous year I achieved an average of 5% every month. Okay, so that's the reason to make a better trader. Or very simple, the other reason over here is that I want to minimize my loss. So last year on average, my average losing trade is 10%. Next year, I want to reduce this loss to 5%. Reason, because I want to minimize my loss. That means I got to do what I call, that means this, you want to embark these reasons. The next key thing is action. So what needs to happen? That means, let's say this year, my average loss per trade is 10% on average. So I got to reduce my trade from 10% to 5%. So how do I do that? That means I got to review my stop loss strategy. Every one of them. It means every trade that I take, what is my stop loss strategy applicable for that instrument that I trade? Maybe if I trade a mix of FX is causing me to lose the most trade, because on average I lose 10%. FX maybe is losing 15% or 18%. Then perhaps this stop loss strategy that I use doesn't apply to the FX market. So this is the action I got to take. Then the next thing is do. So once you realize that this action you got to take, right? How do you do if we got to take action? That means now I realize that what causing my trades to be more than 10% is because certain trading setup in the FX market has a higher losses. So I realized that, hey, the stop loss strategy that I use for trading stock indices doesn't apply to FX market. So I got to do a bit of modification on the FX market. So I got to do some action. Either I don't trade the FX market, or if I want to trade the FX market, I got to modify the stop loss strategy for FX. Okay. So once you got to take action on that. Okay. So how do you take it? I mean, you got to give yourself a push to it. After that, you got to evaluate. I mean, at the end of the day, you have taken action. How is this new action work out? That means you already modify your stop loss, or you do not want to trade FX market anymore. Does it improve your trading performance by making these changes in your overall trading strategy? So you got to evaluate is when and how will you keep track of your progress. So this one you got to do a bit of journaling. So this is a very good concept that I use, a broad base. It's very broad, so you could implement it in bit sizes to do it, but the key thing is setting target, reasons, especially targeting. So this setting of target, right, it actually boils down to a trading, it is related to a bit of trading, a trading plan. Okay, so this trade to success, right, this model, I got to use hand in hand with a trading plan. So right now, I got to share with you what is a trading plan. Okay, so this is also based on my experience, I come up with this trading plan. So a trading plan can be taken on this foundation. It's a foundation. You set up objectives. Okay, so let's say I have short-term objective. Okay, you have a short-term objective. I got to earn X points or pips per day. Pips when you do FX trading. FX trading, we talk about pips. Okay, I got to earn X point and pips per day. Be it realistic, be it your comfortable level. Okay, because everybody has their own individual comfortable level to trade. Okay, then after achieving that, your intermediate objective is when I constantly start earning X point or pips per day, I will increase this point and pips over 2 or 3 months, and I see how it goes. Because right now, let's say for example, I already traded for close to constantly trading close to on average, be it 2 months. So over these 2 months, I constantly earning X pips per day. That means what about, let's say I'm trading FX. So every day on average, I earn about 60 pips. Okay, so 60 pips right now on average every day for 2 months. I already hit my consistent level. I can increase this 60 pips to 120 pips over 2 to 3 months, and I see how it goes. Okay, let's say it doesn't start consistently making decent amount of return. That means you start losing again. That means I got to go back down to 60 pips per day. That means there's something wrong somewhere. That means either you overtrade, you getting too overconfident to place in more trades because you keep, your winnings are kind of, getting snowball on the upside. Then you got to reevaluate your situation. Why do you start to actually lose after having a constant period of winners? Okay, that means you got to look back at your strategy, or maybe the strategy doesn't allow you to trade, more than 60 pips because it's depending on the nature of the trading strategy. Okay, then the long-term objective is I need to be constantly making X amount per year. Okay, it could be $1,000, it could be $5,000 per year, or it could be 10,000. Okay, depending on each individual risk capital that you want to risk. So definitely, if this amount goes higher, that means you want to earn 10,000 per year. That means you got to have a higher risk capital to start with. This hand in hand. That means you want to make more, you got to actually have more trading capital. All right. So if you have a small trading capital, that means you got to be realistic in your X amount of money that you want to make per year. All right. Then some other personal rules. That means this all depending on your lifestyle and your availability to trade. That means I only trade at this time. So this is going to fill in your blank. That means, let's say for example, if you are, most of us are working in Asia time zone. That means from Singapore time, let's say 8:30 a.m. all the way up to maybe 6 p.m. So during this period, I can't be trading. Why? Because I'm heavily involved in my work. All right. So you only can trade after Asia trading hours. That means you only trade about now, which is before the start of the US session, where London is still open. That means you could trade the FX market, or you could trade the indices, Nasdaq, S&P, some of the European indices like German or UK 100. Okay, so that means I only trade at this time. Then I will not trade at this time. That means I will not trade at the Asia hours. Okay, so this one is you got to fill in your blank depending on the time zone that you are comfortable or you have the luxury to trade in. And the next key thing is this one. Okay, so this one is I can't give the number of losses per session because all depending on the amount of risk capital at hand. That means, let's say if I incur X losses or X number of losses per session, I'll stop trading for the day. That means we're talking about if I am now appropriate for a intraday trader, that means I trade on the intraday. That means if I lose, let's say, X number of losses per session, that means right now my session, I will lose $200. Okay, for today, let's say now I'm really $200, I will stop trading for today. That's quite a day. Okay, so let's say for example, if your trading horizon is let's say for example, if it's a week, that means let's say for this whole week itself, suddenly you lose let's say $300 right now. You open one position, you lose $300. That means the next key thing is I got to close this position of $300 and I may stop trading for the week because I got to reevaluate what's wrong with my trading system. or does the trading strategy that I use applicable for the market at this point in time? Okay, then the next key thing is, because this one, Giles earlier I discussed over, is that I got to review my trades on a daily or weekly basis. Okay, so definitely if you are intraday trader, that means you got to review on a daily basis. But if you are swing trader, that means you are holding your position for multi-week. That means you could actually look at the end of the week on the weekend. And also, like I said over here, is that markets are dynamic. That means you got to understand the point that your trading system or the trading strategy that you use, be it technical analysis or be it quantitative analysis, or a mix of both, you got to do constant refining of your strategy. What if suddenly now you feel that, hey, this particular strategy, it works this month, and I realize that when it comes to November, I start making losses by following the same plan of this trading strategy. That means the market that I'm trading right now doesn't go according to this trading strategy. I say trading strategy doesn't work all the time 100% because markets are dynamic. Okay, let's say for example, if my trading strategy is trend following, very simple. Trend following is, let's say for example, what is trend? Let's say we're talking about if we are looking at a bullish trend. If the trend is bullish, that means if prices goes above the previous high by 2%, you initiate a long position. Okay, that's the most simple trend following strategy. So this trend following strategy will work on the long side if price goes according to a nice trading movement on the upside. But however, if the price start goes sideways, imagine if you are trading Netflix last year at this point in time, okay, you realize that you got hit. Because why? Because Netflix since July last year all the way until October this year, or even stretch into early part of this year, is trading in a big sideways configuration. There's no trend in Netflix. All right, so that means, i.e., your trend following strategy on the long side doesn't work really, because the trend has changed for Netflix. So you can't use trend following strategy on Netflix anymore. So you got to check. So what if now you ask yourself, hey, Netflix has been giving me good profit in the last few sessions because of this trend following on the upside, but now Netflix doesn't work. Do I still want to trade Netflix? Some people will keep I still want to trade Netflix. But yes, you can trade Netflix, but you can't use your trend following strategy anymore because it doesn't work. So two things, either because you got to do this study. So to understand this is through X amount of study. So you got to set yourself what's X, how many amounts. So it could be hours, or it could be maybe 3 hours or 4 hours every weekend, or even 2 hours. Okay, these are the personal rules. So next will be your trading method. So this is all boils down to the luxury of time and your personality. So do you want to do as a day trader? So day trader is, that means, i.e., you open a position today, I close my position today. That means, let's say for example, if tonight I long Tesla, if Tesla make a decent profit of $100, I close my trade and I look for the next trade of Tesla or the next trading setup. So this is day trader. That means you don't hold your position more than 1 day, you close it up. Swing trader, that means you tend to hold your position for a week, or sometimes even multi-week, 3 weeks. That means you want to ride on a trend. That means, i.e., for example, if you have a long position in, let's say for example, the Nasdaq 100 index, you're hoping that you aim, because of your trading strategy, the Nasdaq 100 will go higher because there's an upward trend that's developing. That means you tend to hold your position from a daily base, day trader position to a swing trader position. That means you're talking about extend it further to 1 to 3 weeks. Because that being said, over here, that means you got to manage your risk more appropriate being a swing trader. Why? Because being a swing trader, that means your position at risk has a longer duration. That means right now you risk, you're having 3 weeks of unrealized profit. If your position doesn't make money, you have 3 weeks of unrealized profit. So how do you protect this profit is depending on your trading strategy. That means you got to activate certain trading stop loss along the way. Okay, so bear in mind, different trading method will have different kind of strategy to use. Then your style of trading. So this also depending on individual style. Are you a trend follower? That means you trade with the trend. That means you see an uptrend, you trade according to the uptrend. You see a downtrend, you trade according to the downtrend. Or are you a mean reversion trader? That means mean reversion trader applies especially for FX trading in a very short term. Let's say, for example, if you start to see, put it in a way, okay, dollar Canada dollar, dollar CAD. Okay, dollar CAD has been coming down very steeply in the last 5 days. Now it hit a major support. Then you realize that based on certain technical indicators or your trading strategy tells that, hey, this particular decline is overstretched. Potentially, it could be a short-term rebound that lasting 1 day or 2 days or so. Yeah, you could activate this what I call a mean reversion rebound trade. That means you are going against the trend of against that what I call prevailing multi-week downtrend in dollar Canada. Then the key thing to ask yourself is that, is this your style of trading mean reversion? Okay, then some other trading method is this I tend to use, depends on individual, is risk aversion behavior. Is if I start to see 3 losing trades in a row, be it whatever style of trading that I deploy, I will actually reduce my risk capital by X amount in the next trade. Why? Because I'm on a losing trade. I am on a losing trades streak. Losing streak could be anything. It could be bad luck, or it could be that system, the trading strategy that you use doesn't gel, which I got to take time to review why I lose those trades. Okay, so the first logical step is either I stop trading, or you want to place the next trade, I got to reduce my risk capital by X amount, perhaps slash it by half. Okay, then some simple money management techniques or money management rules is no more than 3 losses per trading session. That means this we're talking about intraday trading. So let's say doing intraday trading, if I start to lose 2 losses, I'll stop trading for the day. If you're an intraday trader, then if you're talking about a swing trading over here, is definitely I got to evaluate. So let's say no more than X amount to lose per month. Let's say it could be a percentage of your total portfolio. So let's say remember this month itself, I start to lose 5%. So if I start to lose 5% over here, okay, then I got to really ask myself over here is, I already hit 5%. What should I do next? I got to either stop trading for a while to reevaluate, hey, what's wrong with my trading system? Because if I keep using the same method and trade again, hoping to make back, that 5%, I will lose 10%. So you all know that table, right? The gambler's Rune table. Once you hit 20%, you need to make back 22% of the next trade to cover back your losses. So we do not want to hit that gambler's Rune problem. Okay. Then now we talk about a bit of evaluation now, because about our specific of the trading is that, okay, this one is you got, firstly, you outline your method. What kind of method that you use? Let's say you are using a trend following method. Okay, so you got to create a checklist, either mentally in your mind, that each criteria of your trade must appear before you take it. Okay, let's say we're talking about trend following strategy. So trend following strategy over here is that, okay, in order to follow the trend, the first thing I'm going to check myself is that, is this uptrend still healthy? That means, is this trend still healthy? That means there's no exhaustion in this uptrend. So how do you see it? Either I go down to the higher time frame, the daily time frame, I spot for divergence in the momentum indicator. That's the first checkpoint I got to check. Instead of keep chasing the price. Yeah, I know that this price is very hot. Everybody talking about it. Let's say everybody now is talking about Bitcoin because Bitcoin is going up, touching all-time high. So Bitcoin, I would ask myself, that means, is Bitcoin reaching a point where the momentum is going to get exhausted? So how do I know momentum exhausted? Getting exhausted, I got to use a momentum indicator to gauge it. So that is my first checklist I got to check first before I enter into this bullish trend following trade of Bitcoin. Yeah. Then after that, you got to also understand, you got to write down a journal somewhere. I mean, Excel spreadsheet is that I got to number the amount of winning trades. Okay. And most important, these winning trades, right? You got to look back. Does it follow your method or not? That means, or I just buy on impulse. Buying on impulse and making money, it doesn't gel with your winning trades. So you got to make sure that you got to record your winning trades, and as well as your losing trade as well, to actually refine what's going on in the trading system. Does it follow your methodology and plan? Not just by purely say, hey, I make money on this winning trade, I'm good. Yes, you record this is your winning trade. You'll make, let's say, for example, 100 pips for euro dollar. So does this 100 pips follow my trading plan? Rather than, or is it because of some impulse, I just take this trade based on I see someone giving a trade idea on social media. All right. So these are the kind of method or trading plan that we could use to actually incorporate in our trading journey, hopefully to become a better trader over time. All right. So yes, yeah, just nice. So we're now at 8 p.m. I've come to the end of the session. So I hope that you enjoy. But yes, we still have some time. So I would say that we have about 10 minutes or so. I will now answer your Q&A. Okay, so let me go through the Q&A question. All right. Okay, so firstly, how short is short term? Okay, so this short term thing, right? To me, okay, in my opinion, short term, it could be intraday. Is intraday my short term? Yes, because short term trading, intraday is very short, it's short term. Few days, 1 to 3 days, I consider as short term as well. Okay, so for some people, right, some people may think that 1 to 3 days is swing trading. It doesn't matter. Yeah, it could be a swing trading approach, 1 to 3 days. But to me, I still view that anything that is less than a week, short term. All right. The next question. Okay, is there a mental exercise to get one over the hurdle to just cut loss? Okay, first question, it's going down, but you can think you can hold on and on and on and keep sliding slowly, but keep you sinking with it. Yes, this is the most common problem we as traders face. Why? Because of this forward hope, H-O-P-E, hope. So the key thing about mental exercise is this. So you got to tell yourself, number one, there always be a next trade setup. There will always be a next trading setup. So the key thing you got to ask yourself is just now I said acceptance. So you got to accept losses before it blows up. So how do you accept losses? That the affirmation I share with you is don't be afraid to, if your trade doesn't work well, that means your stop loss level is hit. That means you have a stop loss level you place at $200, all right, for any particular trade. Let's say be it a trade on Alibaba. So once Alibaba hit a stop loss amount of $200, you got to get out already. Okay, don't hope for it to recover. Why? Because you got to accept that, hey, this is a loss I got to accept. And you have a mental framework of it is that Alibaba is not the only stock I can trade. Yes, this trade doesn't jump me well. I lose $200. I'm get out of it, protect my capital, look for the next trade before it keeps sliding down lower and lower. Notice that. So this is a very typical problem. Like even sometimes myself fall into as well. Why? Because at the end of the day is hope and also ego. Because why? Because I tell my friend that I have a bullish view on Alibaba. Okay, because I feel ego, because I cannot accept the point that, hey, Alibaba doesn't goes up by $200 or $400. Instead, it went down by $200 in my trade. So I refuse to cut loss. Why? Because of my ego. Because I need to tell my friend that, hey, that means Kelvin, you are wrong on your view on Alibaba. Yeah, so what? So you got to come to the point that when you're a trader, right, you are different from analyst. Yes, analysts make call in the market, but at the end of the day, once you're trading, right, you got to understand that what's your P&L is your profit and loss. Don't forget about forecasting the price whether it go up or go down. Just you got to react. What is the price of Alibaba is telling you right now? If it's down by $200 and you hit your stop loss, you got to get out. You got to bite your ego, say that, hey, I am wrong in my initial view. I get out of Alibaba. Doesn't matter. Why? Because I know that number one, in trading, there's no 100% certainty. Acceptance of small losses is acceptable. The first key thing in trading is I cannot blow up my capital. Why? Because I got to preserve my capital, and there will be always a next trade or a next opportunity for me to generate better returns. So once I cut up Alibaba, the best thing over here is if you still have that mental block, don't look back at Alibaba again. Search for the next trade. the next better trade or the next potential better trading setup. It could be others, it could be other instrument that you are familiar with, as long as gel in your trading strategy. Okay, is trading plan and trading system the same? Okay, trading plan and trading system, yes, they go hand in hand, because in order to have a trading system is actually builds a subset of your trading plan. All right, they come, I would say it's a subset. Why? Because firstly, you have a plan first. Then after you have that trading plan, then you build a trading system. Like I said earlier, are you a trend follower, or are you trading your style of trading, or are you a more confident in trading mean reversion, or both? Then from there, you're able to build up your trading system. So they come in hand. So your trading system is like a subset of your trading plan. So your trading plan is encompass the trading system. All right. Okay. How do you practice? How do you better practice patience in trading? Okay, this is part. So I do understand somebody is very impatient. Impatient of hoping your trade to hit your target. Okay, hit your target. Okay, so now the key thing about patience. Okay, so to me, very simple is over here is one way to practice patience is this. I got to, okay, firstly, there is a level for me, that there's a level, there's a target level. Okay, let's say for example, if I were to enter, okay, what's position? Okay, let's say I chose a particular stock. Let's say for example, SGX. Okay, SGX. Okay, SGX now is trading close to about. Okay, I'll just give an example. I don't have a view on SGX, so I'll just give an illustration for education purposes. So SGX now is trading at $9.10. So I have a bullish view on SGX, $9.10. So I have an aim for SGX to hit up to $10, within $10, within 3 weeks. Okay, within 3 weeks. So this is my within 3 weeks really. So I have a target 3 weeks. Okay, so definitely the earlier it hit, it better, right? Okay, why? Because I can realize my profit faster. But sometimes, over here is that if prices don't go, let's say I just now is $9.10. So sometimes go about $9.15, $9.20, then drop back to $9.10 again. But you have a stop loss at, let's say, $8.80. But the price still, so now your price is actually trading in the mid, somewhere around, toggling around the midpoint between your profit target and your stop loss. So your position is still on, right? Your position is still on. So now the key thing is you got to ask yourself back, what is your initial target, your time target for SGX? 3 weeks, right? So since you invested on 3 weeks, the target for that. So then the next key thing is, let's say 3 weeks has passed. Okay, 3 weeks has passed. That means you got to, okay, that means, i.e., you don't look at the chart anymore, because you already set yourself. So you set yourself a stop loss, you set yourself a target. That means you do what I call automated price level entry inside the trading platform. Then you don't look at the thing. You only review it, maybe once you set yourself a 3 weeks target, so you review it maybe every end of the trading week, which is Friday or Saturday, to see how it goes, because you're not trading intraday. Okay, you're trading multi-week. So now the key thing, once you hit the 3rd week, right, your SGX price hasn't hit your target yet of $10. It's still hovering about $9.40 now. Okay, now about $9.40. Then that means you hit a time stop of 3 weeks. So then hitting this time stop of 3 weeks, then you got to ask ourselves again, you got to reevaluate the price of SGX. What is it doing? Is there any momentum that is coming into the picture of the price? Okay, or would there be a potential trend reversal on the downside that is coming in? Okay, then you got to ask this question. Then the next question over here is that if neither of them, that means it's still just trading sideways. I mean, there's no risk of trend reversing down to the downside. Then the next key thing is that you got to ask yourself, do you want to hold on to this position because you hit your time stop of 3 weeks? Okay, if you hold on, that means there will be opportunity costs because your trading capital is being tied up to SGX. Or do you want to free up your trading capital because there's a better position out there? If there is, So you could actually free up your position capital to trade for the next position. So you ask yourself that at this point in time, hey, yeah, so what? I did hit I didn't hit $10, I hit 950, I make a small amount of profit. Yeah, just move on. Better than making a loss, right? So this is the reaffirmation part again as well. Okay. Okay. Is it suitable to trade swing within a major trend? Where is it? Is it suitable to trade the swings within the major trend? Okay, so this swing trading, so definitely the answer is, I would say that if you are a swing trader, that means your trading style is swing trading. Yes, definitely a yes. That means the next key thing we got to ask ourselves is over here is that your trading system or your trading strategy involves swing trading within a major trend. Yeah, the answer is true. Is yes, it's suitable to trade, except that over here is that the next key thing over here is, like I said earlier on, is that you got to know when is the probability of this major trend got to reverse. Okay, but there's a lot of ways you can look at it. This is your trading strategy. And most importantly, over here is, yes, for swing trading, we have a longer time period. We're talking about 1 to 3 weeks. You still got to apply a stop loss level to get out of your trade. If there's a sudden change in the trend. Because like I said earlier on, a trend reverse, sometimes it takes time to reverse. Okay, sometimes it takes time. If it takes time to reverse, that means we are fortunate. Why? Because this reversal could be picked up by momentum indicators. In terms of probability, it can be shown in some momentum indicator like RSI or MACD that a major trend is reversing. But what if the major trend start to reverse without time, without allowing for time? So there's a sudden shock in the system. Okay, let's say for example, if you are trading a particular stock, let's say be it DBS, okay, DBS, say DBS in the trend is the uptrend, but suddenly DBS has a huge loss in some, some whatever portfolio, because DBS invested in, let's say for example, I'll just give an example, is that suddenly it has a huge loan portfolio that faces drastic amount of $1 million losses. Suddenly the news just came up, then DBS itself, the trend could actually immediately reverse very fast on the downside. Okay, so once that happened, right, momentum indicator will not be able to pick up because this news is not being made known to the public yet. Suddenly it just bursts out of nowhere. So technical indicator will not show, momentum indicator will not show. So the key thing is the only way to prevent you for adverse loss over here is that you got to have a stop loss beforehand. All right. Okay. Don't you think discipline is all important in trading? Yes, definitely. So that's why we got to do proper risk management. And the trading plan early on I shared with you all in terms of discipline. That means we're talking about ourselves that we can't be trading on impulse. We got to use what I call, that means we got to follow our trading, whatever the signals from our trading strategy to actually help us to actually buy, not say buy, to actually establish a bullish or bearish position based on the trading strategy that we use, rather than trading based on impulse. So impulse could be, by just looking at social media, someone is saying that XYZ stock is bullish or euro dollar is bullish, or let's say for example somebody said that Dow Jones now, because Dow Jones is at a high or S&P is at a high, there's a risk of a reversal. Okay, I mean, before we jump into such conclusion, we got to ask our trading strategy. That means before we take into every trade must be properly evaluated based on a trading strategy. That means there must be a flow based on the trading plan. All right. Then the next question, you are on the wrong side of you're on the wrong side. Stop loss hit. Way better to trade in the continuing momentum. Okay, so I try to rephrase this question now. Hopefully I'm correct. So let's say if you are on the long side, that means of the trade, your stop loss is hit. So now, example, you're trading on the long side, your stop loss is hit. That means prices come down. So will it be better to trade in the continuing momentum? That means right now you start to see stock price coming down. The stock price come down, hit your stop loss. Okay, so this question over here is I got to ask myself, this one, is a bit built down on a bit of technical analysis really to answer that question. Yes, stop loss hit. Okay, so now if I'm trading on the wrong side, that means my stop loss is hit. So I'll ask myself, this stop loss that I place, okay, let's say if I'm trading on a hourly time frame, okay, on hourly time frame. So on an hourly time frame, my stop loss is hit. On the bullish side, stop loss is hit. So this stop loss is derived from a support level. Okay, so then I'll ask about this support level, right? Is it derived from a higher time frame? Let's say on the daily chart. So if you see the daily chart, right? If this daily chart has, yes, support level hit, so on the daily chart, the support level is broken to the downside. Has it reversed the trend on the daily chart? On the daily chart, you see an uptrend. So has it reversed this downtrend on the daily? Has it reversed the uptrend on the daily chart? And on the daily chart, you can see where is the next support level. Okay, so if the next support level is very close, no point continuing chasing on the downside. That means there could be a potential reversal to the upside, provided that the daily uptrend is still intact. Unless you tell me that the daily uptrend has the trend, that means the uptrend on the daily chart has started to reverse to the downside by the break of that stop loss level, then you trade accordingly to a potential trend reversal to the downside. That means continuing that downside momentum. Okay, so that means you got to reevaluate. The most important thing is that look at the higher time frame. Yes, stop loss hit, you go up to the higher time frame on the daily chart. Has the uptrend been reversed to the downside? If yes, we could actually follow that downside momentum because it's a trend reversal. If the daily uptrend is still intact, it could be just a minor, minor break. It could be just what I call a minor corrective decline before the trend reverses up again to the upside. Okay, so this is a kind of trading strategy that I can share with you, okay, by doing this kind of situation. Yeah, that's something we got to move ourselves at. Is it worthwhile to trade in that continuing momentum, the short-term momentum? Sometimes it's not worth it. I rather trade with the main trend that is still on the upside on the daily chart, and also depending on the reward risk ratio as well. Whether is it good to take that risk versus the reward of that down that what I call short-term spurt in the downward movement of the trend. Okay, do you think we retail traders have any chance against the big institution? Okay, so definitely, right. Retail traders, we don't have order flow. We can't see proper order flow. Big traders, institution, they see the order flow. That means they tend to know. Okay, because okay, the thing about trading is all this over here is that order flow, right? Especially trading stocks. So for institution like order filling banks, we're talking about, it could be UBS, it could be Deutsche Bank. They could able to see fund managers order flow ahead of us. Because why? Because fund managers, right? Fund managers, in order for them, because when fund managers come in, they tend to buy in bulk. We're talking about maybe 100 over lots, 200 over lots, even more than that. So in order to not move the price, they do it. They try to enter a VWAP price, volume weighted average price. That means they will break down their trade accordingly. So by breaking down the trade accordingly, some institution able to spot their, because they use this institution as a, as the prime broker, they're able to see their trades coming in bit by pieces. So some of their, okay, actually it's illegal. So some of them, they tend to place a trade before or with that, with this institutional flow. So the thing about for us retail traders, we can't, because we don't have the luxury of such institutional order flow. So what we could do over here is that we could only see this trade coming in when there's a momentum. That means what we do as a retail trader over here is that once the momentum, we spot this momentum, we try to get in fast. Okay. Or once this momentum is being built ready, okay, that means we don't be greedy. So instead of getting $100, right? Okay, instead of getting $1,000 out of trade, we get $200. It's fine. That means we eat a bit of that momentum. Because we can't get in fast. We only get in when the momentum is being seen. Let's say, for example, instead of day one, we can't get in day one. So we only get in around day 3 when the momentum is being built. Or maybe sometime day 3 you miss it, you only get it in day 7. It means 7 days when the momentum is built already by the institutional flow. So we get in day 7, then they're going to ask ourselves over here is that, has this momentum, they've got to look at the momentum over here. Has the momentum died off yet? Then you've got to ask ourselves, wait, remember, retailers, we got to accept that the fact that over here is that we can't beat the institution. So we get small amount of profit, constant profit is very good enough for us. That means we enter in a bit late. Yeah, momentum has really built up already because of day 7. You miss it at day 3, you enter at day 7. Then if you look at your technical chart, the momentum is still strong. Over here is that, hey, we can still make decent potential profit of this trend, but we can't make so much as institutional traders. So we got to live with that. Mainly this is a fact of life. So as long as we retailers, we make consistent small amount of profit is very good. So it's like I said earlier, the reaffirmation is good to celebrate. It's a must to celebrate every winning trade, be it small or large, rather than why? Because yes, I make $100 or $200, but instead of having a loss, which is very good in terms of trading. All right, so I believe I come to the last question. Is there anyone have any more further question? Oh, sorry about that. We tend to stretch a bit to 20 minutes. So have anyone have any questions to ask? Because we stretch a bit more to 20 minutes, but I tend to be a bit long-winded. Okay, so okay, I think got some more question I didn't see. So I try to answer a few more questions. Okay, let me see. Because it's so. Okay, big institutions seems to already know or can see our stop loss. Okay, so now the problem is over here is this is what we call, some people believe in stop loss hunting. Okay, stop loss hunting. Okay, so now okay, this is more on your trading strategy. Okay, yes, there is stop loss hunting going on, especially in the FX market. So it depends on what kind of instrument you are trading at. There's a risk of stop hunt. Stop hunt, to me, in my experience, yes, FX market happen prevalently all the time because of the order filling banks able to see every stop loss. So the key thing over here is that for certain instrument, you realize that if there's a risk of stop loss hunting, you, to prevent that from happening, you got to enter the trade on the bullish side when the price pull back instead of breaking the peak. Okay, because some of us, right, because of impulse, right, we tend to enter a trend when the price break higher. We call it break peak. That means we break 1% above the prior high, then we put in a trade. This is a typical, very simple trend following method. So if you realize that there's always this stop loss hunting going on, that means suddenly the price will start to push down before reversing up again. So what you could do over here is that instead of breaking peak for trend following, you reverse the psychology over here is that you wait for the price to drop to a minor support. Okay, drop to some minor support before you take that trade. So this is how to prevent what I call stop loss, stop hunt. If they hunt your stop loss, yes, you got hunted, but your losses, you minimize it. That means for trend following, instead of breaking peak, you attempt a bullish opportunity setup at the minor support rather than wait for the price to break up higher. So this to what I call, if you start to realize that there's a lot of prevalent stop hunting that is going on, that you, I mean, based on your what I call analysis of the trend in the past, okay, and especially sometimes for FX market, this stop hunt tend to happen after major economic data release. Like for example, we're talking about non-farm payrolls, US retail sales, okay, etc. Or for example, Fed FOMC meeting. Okay. Okay, then one more. Okay, so I believe that okay, let me see. Okay, FX, unlike stocks in the commodities, can't be manipulated by big boys, so it's a fair game to all three. Okay, yes, FX is liquid. Yeah, I mean it's hard to manipulate in terms of price movement, but let's say that on the stop hunt is still potentially prevalent in FX because of the order flow books that some of the FX order filling bank can see. Okay, there's still a risk. Yes, even though the price movement can't be manipulated, that means because there's more players inside in the FX market. Because you know the FX itself, because FX is very short term, a lot of people tend to place stop loss order, you know, to protect their trade for short term traders. So this stop loss order sometimes can be seen by order filling banks who tends potentially to stop hunt. Okay, which I explained earlier on. All right. So good. So I hope that I will answer all your questions. So yeah, really 8:30, really 30 minutes from there. So I hope that you're able to actually learn up from this. So before we go, right, I want to share with you all something. So to me, I'm so active on social media. Okay, social media. So you could actually follow me on. Everyone can see my screen, right? So you yes, can see my screen. So basically, you can follow me on social media at Twitter. So you can open a Twitter account, is free. So you tap at Kelvin SC Wong. So you follow me and you on the notification. So I do provide what I call market commentary on a daily basis as well. Okay, so what's going on in the market? So if something is a good rate before the start of a trading week or trading day. Okay, then I also give what I call some market outlook as well. Let's say usually I start the week with the key technical levels and trend bias of the major stock indices. Okay, then you could actually follow CMC SG, okay, CMC SG YouTube channel, okay, CMC SG YouTube channel. So CMC SG YouTube channel, there's a great playlist of trading education, okay, and I will upload my weekly technical analysis outlook on Monday, means on every Monday around 3 p.m. to 4 p.m. for the week ahead, me for that particular week. Okay. All right, so Facebook, no, I don't have Facebook. Okay, of course, you know, Facebook itself, I don't tend to use Facebook because Facebook, I find it because it's too cumbered with a lot of news flow, and plus some of the news flow is a bit redundant because of all those advertising. So I tend to stick with Twitter, which is much more neat and tidy in terms of looking out for news and looking out for what we call it tweets about some other followers that I follow on the market. All right. So with that, I hope that you're enjoying this particular session, and definitely it's not the end of one trading journey. So we got to actually start from somewhere and keep on learning to become a better trader. All right. So with that, thank you for your time. And I hope to speak to you all again in my next webinar. And hopefully next year things get better. I could see you all in person. All right. Thank you.